Over the last several days, something unusual has been developing beneath the surface of the silver market, not in the sense of a single dramatic headline or a one-day price spike, but in the way the market itself has been behaving when placed under stress. Most price movements come and go without altering the broader structure. This one has begun to draw attention precisely because it has not behaved the way past silver rallies typically have. At the time of observation, silver has been trading well above levels that for decades acted as firm ceilings rather than temporary resistance. For much of the last half-century, silver oscillated within wide, but ultimately contained ranges, even as other commodities reset to higher price regimes. Copper, lead, and gold each established new baselines over time, while silver repeatedly surged and retreated, failing to hold those advances for long. That historical context matters, because markets that remain range-bound for extended periods tend to accumulate latent pressure as fundamentals evolve beneath a largely unchanged price structure. What has shifted recently is not simply the price itself, but the character of the pullbacks. In prior silver advances, corrections tended to unfold over months, gradually relieving excess positioning before the next leg higher. In contrast, recent declines have been brief and sharply contested. Based on available data, a drawdown of roughly mid-teens percentages was absorbed in a matter of days rather than weeks, with buying interest reemerging quickly and pushing prices back toward prior levels. This pattern does not on its own confirm a new regime, but it does suggest that the marginal buyer may be behaving differently than in earlier cycles. One interpretation is that a larger share of demand is no longer driven purely by short-term speculation. Industrial users, for example, tend to approach price weakness differently from financial traders. For a manufacturer dependent on silver as an input, temporary price declines can represent an opportunity to secure supply rather than a signal to reduce exposure. Similarly, longer-term holders focused on balance sheet diversification or inventory security are less sensitive to short-term volatility. If these groups represent a growing share of demand, it would help explain why declines have been shallow and quickly retraced. The shift becomes more relevant when viewed alongside longer-running supply dynamics. For several consecutive years, global silver consumption has exceeded newly mined supply. Estimates vary by source and methodology, but most converge on a persistent annual shortfall that has not been fully offset by recycling. Such deficits are not uncommon in commodity markets and do not always lead to immediate price adjustments. Inventories can absorb imbalances for extended periods, particularly when above-ground stockpiles are ample or when demand growth is uneven. However, prolonged deficits tend to change the system incrementally. High-grade ore bodies are depleted first, raising marginal production costs over time. New projects require capital permitting and long lead times, often measured in years rather than quarters. If prices remain suppressed relative to rising costs, investment in future supply can lag, tightening the system further. None of this guarantees a rapid repricing, but it does increase sensitivity to demand shocks or shifts in investor behavior. On the demand side, silver occupies a distinctive position among industrial metals. Its physical properties make it difficult to substitute in certain applications, particularly where conductivity, reflectivity, or reliability are critical. Solar manufacturing, power electronics, advanced medical devices, and data infrastructure all rely on silver in varying quantities. While efficiency gains can reduce usage per unit over time, overall consumption can still rise if end market volumes expand faster than thrift improvements. At the same time, silver retains a monetary and investment dimension that most industrial metals lack. Historically, this dual role has contributed to higher volatility, especially during periods of macroeconomic uncertainty. When confidence in financial assets weakens, or when currency dynamics become unstable, capital can flow toward tangible stores of value. Gold has traditionally captured the bulk of that demand, but silver has often followed with greater amplitude due to its smaller market size. One way analysts attempt to contextualize this relationship is through the gold-to-silver ratio, which expresses how many ounces of silver are required to equal the price of 1 ounce of gold. Over long spans of history, that ratio has fluctuated widely, compressing during precious metal bull phases and expanding during periods of stress or disinterest. At present levels, the ratio sits near its longer-term averages rather than at extremes, which some observers interpret as evidence that silver has not yet experienced the type of relative repricing seen in past cycles. It is important, however, to treat such metrics as descriptive rather than predictive. Ratios do not dictate future prices. They simply summarize relationships at a point in time. There have been extended periods when the ratio remained elevated or compressed far longer than historical norms would suggest. As with all comparative tools, context matters, particularly the broader macroeconomic environment and the specific drivers of demand and supply at play. Technical analysts who focus on momentum and market structure rather than price alone often emphasize this distinction. Price can be thought of as the visible outcome, while momentum reflects the underlying force driving that outcome. In past commodity cycles, sustained shifts in momentum have preceded large price moves by months or even years. In some historical cases, momentum indicators reached levels not seen for decades before prices responded in full. That said, momentum analysis is not infallible. Signals can fail, and strong readings can persist without leading to dramatic outcomes if external conditions change. This is why cautious frameworks emphasize confirmation over time rather than single inflection points. From this perspective, the recent behavior of silver may be interpreted as an early-stage transition rather than a completed one, with subsequent market action needed to validate or refute that interpretation. Overlaying these structural and technical considerations is a broader macro backdrop marked by elevated debt levels and policy intervention across major economies. Publicly available data show government debt relative to output at levels that historically have coincided with periods of financial repression or accommodative monetary policy. When bond markets exhibit stress under such conditions, central banks often face limited options, balancing financial stability against inflationary risks. In past cycles, environments characterized by persistent intervention and low real yields have coincided with increased interest in hard assets. This does not imply intent or coordination on the part of policymakers, but rather reflects how market participants respond to incentives and constraints. Precious metals, including silver, tend to attract attention during such periods precisely because they sit outside the conventional credit system. Equity markets add another layer of complexity. Valuations, volatility, and earnings expectations fluctuate over time, and periods of elevated uncertainty can prompt portfolio reallocations. Historically, major rotations have not occurred all at once, but have unfolded unevenly, with capital moving incrementally as conditions evolve. Commodities have often benefited during such transitions, though not uniformly or without significant interim drawdowns. Physical market indicators offer additional context, though they too require careful interpretation. Delivery volumes, inventory reports, and regional price differentials can signal tightening conditions, but they can also reflect temporary logistical issues or regulatory changes. Short-term spikes in premiums or delivery requests do not necessarily indicate systemic stress, yet persistent patterns over multiple reporting periods can suggest growing friction within the supply chain. Retail activity is particularly prone to exaggeration in both directions. Periods of heightened interest can lead to temporary shortages or delays, especially for popular products, even when underlying supply remains sufficient. Conversely, subdued retail demand does not preclude strong institutional activity elsewhere in the market. Separating signal from noise requires examining multiple data points rather than isolated anecdotes. Mining equities, often discussed alongside physical silver, introduce further variables. Their performance depends not only on metal prices, but also on cost structures, jurisdictional risks, balance sheets, and management decisions. In rising price environments, operating leverage can amplify gains, but the same leverage works in reverse during downturns. Historically, even strong commodity bull markets have featured sharp equity drawdowns that tested investor conviction. This volatility is not an anomaly, but a defining characteristic of the sector. During previous precious metal advances, interim declines of 20% or more were common, even as longer-term trends remained intact. Participants who were unprepared for such swings often exited prematurely, while those with longer horizons endured periods of discomfort in exchange for eventual alignment with the broader trend. From a behavioral standpoint, this dynamic reinforces why early-stage transitions are often met with skepticism. Markets rarely move in straight lines, and initial advances are frequently dismissed as temporary or overextended. Only later, after repeated confirmations, does broader acceptance emerge. By that point, much of the repricing has already occurred, leaving less margin for error. At present, silver appears to be situated in a phase where multiple interpretations remain plausible. It may be entering a sustained revaluation driven by structural forces, or it may be experiencing an extended but ultimately cyclical advance within a still intact long-term range. Distinguishing between these scenarios depends on how supply responds, whether industrial demand maintains its trajectory, and how broader financial conditions evolve. What can be observed based on current information is that the market's reactions to stress have changed in measurable ways. Pullbacks have been absorbed more quickly, relative performance metrics have shifted, and attention from diverse participant groups has increased. Whether these developments represent the early contours of a new regime or simply an unusual chapter within an old one remains an open question, and answering it requires continuing to examine how the underlying mechanisms interact as conditions unfold. As conditions unfold, one area where those mechanisms become especially visible is in the way physical availability and paper pricing interact during periods of sustained demand. Silver trades globally through a layered system that includes futures markets, wholesale bars, fabricated products, and end-user inventories. Under normal circumstances, friction between these layers is minimal. Price signals travel smoothly, inventories rotate, and temporary imbalances resolve without attracting much attention. When demand becomes persistent rather than episodic, that balance can shift. Futures markets may continue to reflect ample liquidity while downstream participants encounter delays, higher premiums, or changes in contract specifications. None of these developments taken alone imply stress. They often reflect rational adjustments as market participants respond to changing order flows. But when such adjustments occur across multiple venues and persist over time, they can indicate that the system is adapting to a different equilibrium. Premium behavior is one such signal. In calm markets, premiums on fabricated silver products tend to remain narrow, fluctuating within predictable bands tied to fabrication and distribution costs. During periods of heightened interest, those premiums can expand as inventories turn over more quickly. This does not mean silver is unavailable, but it does suggest that readily deliverable supply is being absorbed faster than usual. The distinction matters, because price discovery typically occurs at the futures level, while physical tightness often appears first in premiums and delivery timelines. Another indicator is contract innovation. Exchanges periodically introduce new contract sizes or adjust margin frameworks in response to participant needs. These changes are administrative in nature, but they also reflect who is active in the market and how they are choosing to engage. A rise in demand for smaller or more flexible contracts, for example, can signal broader participation beyond traditional institutional players. Conversely, higher margin requirements can reflect an effort to manage volatility rather than a judgment about direction. Inventory reporting provides further context, though it too must be interpreted carefully. Reported stocks represent a metal that meets specific criteria and is registered within particular systems. They do not capture all above-ground silver, nor do changes necessarily imply shortages. Inventory levels can decline because metal is moving to other uses or jurisdictions, or because holders choose not to make it available under existing terms. What matters analytically is not a single drawdown, but the trend over multiple reporting periods and how that trend aligns with observed demand. Regional price differentials add another layer. When silver trades at materially different prices across major markets, it reflects localized conditions such as taxation, logistics, currency effects, or demand concentrations. Persistent differentials can encourage arbitrage, pulling metal from one region to another until the gap narrows. If those gaps remain wide despite such incentives, it suggests that non-price factors are influencing flows, at least temporarily. These physical considerations intersect with macrodynamics in ways that are not always intuitive. Silver's industrial demand ties it to economic activity, while its monetary role links it to confidence and policy. In environments where growth expectations are mixed and policy responses are uncertain, these influences can reinforce each other rather than offset. Industrial users may continue to secure supply for long-term planning, even as investors seek diversification, compressing available float without a corresponding surge in speculative turnover. Skeptical perspectives point out that similar arguments have surfaced before, often prematurely. Silver has a history of false starts, where compelling narratives failed to translate into sustained repricing. In the early 1980s, the market experienced an abrupt collapse after a sharp advance, followed by decades of underperformance. In 2011, a rapid rise was followed by an equally swift reversal, leaving long-term holders with losses despite strong fundamentals at the time. These episodes underscore that structural stories do not guarantee outcomes. What differentiates the current environment, according to some analysts, is the duration and breadth of the underlying pressures, rather than their intensity at any single moment. Supply constraints have persisted for years rather than quarters. Industrial demand drivers are embedded in long-term infrastructure trends rather than cyclical expansions. Monetary conditions reflect accumulated policy choices rather than isolated interventions. Each factor on its own might be manageable. Together, they create a more complex backdrop. The concept of a structural shift is often misunderstood in this context. It does not imply a straight-line move or the absence of volatility. Instead, it suggests that the reference points market participants use to assess value may be changing. Prices that once seemed elevated can become normalized if costs, demand, and risk perceptions adjust. Conversely, prices that appeared cheap can remain so longer than expected if those adjustments fail to materialize. From a historical standpoint, commodities that eventually repriced after long consolidations often exhibited prolonged periods of ambiguity beforehand. Signals accumulated gradually, with each new data point adding marginal weight rather than delivering clarity. Participants who demanded certainty rarely found it. Those who focused on probabilities rather than predictions were better positioned to adapt as conditions evolved. Behavioral factors play a significant role during these transitions. Early advances tend to attract specialized participants who are comfortable with complexity and uncertainty. Broader participation increases only after narratives simplify and performance becomes visible in mainstream benchmarks. This progression can amplify moves later in the cycle, but it also increases vulnerability to sharp reversals when expectations outrun fundamentals. In silver's case, the relatively small size of the market magnifies these effects. Modest shifts in allocation can have outsized impacts on price, especially when inventories are not expanding. This leverage cuts both ways. It can accelerate advances, but it can also intensify corrections, reinforcing the perception of instability even when underlying drivers remain intact. Mining supply responsiveness illustrates this asymmetry, even at higher prices. Production cannot increase quickly due to geological, regulatory, and financial constraints. Capital allocation decisions made today may not yield additional output for years. As a result, short-term price signals have limited influence on near-term supply, increasing reliance on inventories and recycling to balance the market. Recycling itself is sensitive to price, but also to infrastructure and behavior. Higher prices can incentivize recovery of scrap, but the response is neither immediate nor unlimited. Certain forms of silver use, particularly in electronics, are difficult to recover economically. This limits the extent to which recycling can offset sustained deficits, even in favorable conditions. Against this backdrop, comparisons to other commodity cycles offer perspective rather than prediction. Copper, for instance, experienced a prolonged consolidation before a multi-year advance driven by urbanization and infrastructure spending. That advance was punctuated by severe corrections that tested participants' resolve. Lead and other base metals followed similar patterns, though with different magnitudes and timelines. In each case, the eventual repricing was evident only in hindsight. Applying those analogies to silver requires caution. Silver's dual role introduces variables absent in purely industrial metals. Monetary demand can surge or retreat rapidly in response to policy signals, while industrial demand tends to evolve more gradually. The interaction between these forces can produce outcomes that diverge from historical templates, particularly in a globalized financial system with instantaneous information flow. Current skepticism and mainstream commentary reflects this uncertainty. Analysts accustomed to range-bound behavior are understandably cautious about extrapolating recent trends. Overextension, speculative excess, and mean reversion are familiar risks. Acknowledging these risks does not negate the possibility of a transition. It contextualizes it within a framework that recognizes both upside and downside scenarios. One alternative explanation for recent strength is that silver is benefiting indirectly from broader commodity exposure rather than from silver-specific drivers. In this view, allocations to real assets as a class are lifting prices temporarily, with silver participating due to its liquidity rather than its fundamentals. If those allocations reverse, silver could retrace without having resolved its longer-term imbalances. Another counterpoint emphasizes technological substitution. While silver remains critical in many applications, research into alternative materials continues. Incremental efficiency gains or breakthroughs could reduce demand growth over time, easing pressure on supply. Such developments are difficult to forecast and tend to unfold unevenly, but they represent a non-trivial variable in long-term assessments. These counter-scenarios highlight why sustained observation is essential. Structural shifts reveal themselves not through isolated metrics, but through consistency across domains, pricing behavior, physical flows, investment patterns, and policy responses. When these elements align repeatedly, confidence in a new regime increases. When they diverge, caution is warranted. At present, the silver market appears to be navigating this ambiguous middle ground. Signals suggest increased sensitivity to demand and reduced tolerance for supply disruption. Yet, definitive confirmation remains elusive. The market continues to process new information, adjusting incrementally rather than decisively, as participants reassess assumptions that have held for decades. Understanding this process requires attention not just to what is happening, but to how quickly the market adapts and which participants are driving that adaptation. Whether recent developments mark the early stages of a lasting repricing or a complex extended fluctuation within an old framework depends on how these dynamics interact as the underlying mechanisms continue to unfold. One of the more revealing aspects of this phase is how expectations are being recalibrated without a single dominant narrative taking control. Markets that transition cleanly from one regime to another often do so with broad consensus forming quickly. Here, agreement remains partial and fragmented, which in itself provides useful information about where the process may stand. Policy conditions remain a central variable. Monetary authorities across major economies operate within constraints shaped by debt servicing requirements, growth objectives, and financial stability concerns. Public data show that maintaining orderly bond markets has become an increasingly delicate task, particularly when inflation expectations fluctuate. Interventions designed to smooth volatility can stabilize conditions in the short term, introducing longer-term trade-offs. For assets like silver, which sit outside the direct reach of policy instruments, these dynamics influence perception more than mechanics, affecting how different participants assess relative value. At the same time, industrial planning cycles operate on horizons that extend well beyond quarterly market moves. Manufacturers that rely on silver-intensive components often base procurement decisions on multi-year outlooks rather than spot prices alone. If uncertainty increases, securing supply can become a priority even when prices appear elevated relative to recent history. This behavior does not require panic or scarcity. It reflects risk management within complex supply chains. Financial participation introduces a different cadence. Investment flows can respond quickly to shifts in sentiment, correlations, or macro indicators. These flows are often episodic, amplifying short-term volatility without necessarily altering long-term fundamentals. When investment demand overlaps with steady industrial consumption, price sensitivity can increase, producing sharper reactions to incremental data. This interaction helps explain why silver has historically exhibited outsized swings compared to larger markets. Its liquidity is sufficient to accommodate global trade, but not so deep that large reallocations pass unnoticed. As a result, periods of transition tend to feel unstable, even when changes are incremental in aggregate terms. Another layer of complexity arises from currency dynamics. Silver is priced globally in US dollars, but consumption and production are distributed across regions with differing monetary conditions. Exchange rate movements can alter local affordability and incentives, influencing regional demand patterns independently of headline prices. Persistent divergence between local and global conditions can shape flows in ways that are not immediately apparent from aggregate data. Looking at past cycles, one common feature of mature repricing phases is the narrowing of plausible alternative explanations. Early on, multiple narratives compete, each offering partial insight. Over time, the explanations that fail to align with observed behavior lose credibility, while those that consistently match outcomes gain acceptance. The current environment suggests that this sorting process is still underway rather than complete. Risk considerations remain central throughout. Volatility has not disappeared, nor should it be expected. Historical precedent shows that even during extended advances, commodities experience deep interim declines. These drawdowns are not anomalies. They are mechanisms through which positioning resets and information is absorbed. Interpreting them requires distinguishing between structural stress and routine recalibration. From a probabilistic standpoint, several broad scenarios remain viable. One is a continuation of gradual repricing as supply constraints and demand trends persist, punctuated by periodic corrections. Another is a stabilization within a higher but still bounded range, if substitution, recycling, or macro shifts ease pressure. A third involves renewed weakness if financial conditions tighten unexpectedly, or if demand assumptions prove overly optimistic. None of these outcomes can be ruled out based on current information alone. What differentiates a measured analysis from a speculative one is not the absence of conviction, but the acknowledgement of uncertainty and range. Silver's market structure today reflects accumulated pressures, adaptive responses, and unresolved questions. Each new data point modifies probabilities rather than delivering definitive answers. In this context, the most informative signals are often those that persist quietly rather than those that attract immediate attention. Changes in procurement behavior, incremental adjustments, inventory management, and the steady evolution of policy frameworks tend to matter more over time than isolated price spikes or commentary. Observing how these elements interact provides a clearer picture than focusing on any single indicator. The process remains dynamic. As participants continue to test assumptions against reality, feedback loops develop, reinforcing or challenging prevailing views. The silver market, long accustomed to oscillation without resolution, is now navigating a phase where long-standing reference points are being re-examined. Whether this leads to a durable redefinition of value or a complex reversion will depend on how these interconnected mechanisms resolve as conditions continue to evolve.